Hello, this is our BSG Company Presentation. We're Group A or Company A, and the people in our group are Ricky Bell, Michael Darden, Cody Gamble, me, and Lexi Ellingson.
Annual total revenue trends is an analysis of the company's past selling records at a given time. It makes the company familiar with the usual behavior of the customers and gives an idea of the preferences. Year-over-year analysis is much better than month-to-month comparison since it gives a much bigger picture of trends over time. We have seen a great growth of our annual total revenue trends in our first year. Our annual total revenue trend was at $200 million. We have steadily seen a big increase in our revenue trends every year. These increases have been $50 million in 5 of our last 7 years in business. Currently, our annual total revenue trend has reached our highest amount of $525 million. We are confident that with our marketing, great quality, outstanding image, and low price, we will continue to be a leader in our industry as long as we follow our strategic plan. Return on equity shows how much profit a company earned in comparison to the total amount of shareholder equity found on the balance sheet. Shareholder equity is equal to total assets minus total liabilities. This return on equity is an important measure for a company as it compares the company against its peers. Return on equity is something we have struggled with but are now starting to see the returns we expect for our company. The higher return on equity, the more easily our company will be able to raise money for growth. This is why as a company we're striving to make our return on equity higher for our shareholders. In year 11, our return on equity was at 20.5%, and our current year is 20.3%. In year 12, we got our return on equity all the way up to 28.8%. We have seen a slight drop off since that year, but are now starting to make a comeback on our return on equity. Currently, our current average is at 15.5%, which put us at third in our industry. We have balanced out our production of our plants, which only increases return on equity for our shareholders. Growth in earnings per share is an important measure of management performance because it shows how much money the company is making for its shareholders. Our earnings per share is something we have strived to attain and to beat our investor expectations. We have succeeded in this. Every year we have met our investor expectations and exceeded them in many years. We actually doubled our investor expectations in several years, and this gives our investors the trust in us that we will not fail them. Our return on earnings per share has been consistent and above the average of our competitors. In the years we have been in business, we have been number 2 twice in our industry in earnings per share. We have been number 1 5 times since we started the business, which is by far the best in the industry. In year 11, our earnings share was at 3.46%, and now in our current year, we have raised it all the way up to 10.45%. In our current year, this puts us almost 2 percentage points ahead of our nearest competitor. Over the lifetime of our company, we have an earnings per share of 5.71%, and our closest competitor has a lifetime average of 5.10%. This shows that by far we're the best company at earnings per share.
Our annual rating credit was pretty good for Company A. Our credit investors wanted us to maintain at least a B+, and we did that every year except 1 year, and it was year 12 where we had just a B+ rating. That was our lowest year we had. We took pride in maintaining our business rating, or our annual credit rating, to keep it as high as possible. We felt like that was one thing that was very important to us, and we thought that would be one thing that would pay off in the future. We had our highest credit ratings from year 14, 18, 19, and 20, and that was at A+ rating. We exceeded the expectations of the investors, and we felt like we did a good job doing that, and we did it professionally and all.
This slide shows our annual year-end stock price. The year-end stock price can be affected by a variety of different things. Some of the external factors are the return on equity, the earnings per share, and just generally how the business does in comparison to other businesses in the game. And it can also be affected by internal factors like stock buybacks, selling stock, and sending out dividends. And we use this to our advantage. Up to year 12, we built up our stock price, and then when we decided we were going to build a factory, we sold a lot of our stock in year 13. This gave us the funding necessary to build the factory that we wanted, and well, at the same time it did drop our stock price, but it helped keep our credit high because we could fund most of our investments. And then after that, we focused on getting the stock price up and keeping it that way.
Our annual credit rating, when it comes to that, there's a couple things that we took in consideration to increase the image credit rating of our company. Number one, the products and services that we offered in each region. We believe like the more models that we offer and the better service that we have, such as a rebate and stuff, we felt like that was going to pay off the most. The number 2 point is the market shares for each region and the product in each region. We felt like if we were able to gain the most market share of that region and stuff, that our image rating would have gone up for that year. And also the effort to demonstrate good corporate citizenship and social responsibility. In my opinion, we were never awarded with the corporate social responsibility company, and I think it's because we didn't choose to use a green options like such as the recycle boxes and stuff. We didn't see that as a benefit for us, but it would have been a benefit. The investors expected us to maintain a 70 image rating all year. In years 9 and 10, we reached a bare minimum, which was at 70. And in the years after year 11 through every year after year 11, we averaged a 93.22 image rating.
So for our strategic vision for our company, we really set out to differentiate ourselves from the competitors. And we took a lot of inspiration from Nike. We really wanted to portray ourselves as a really high quality company by using high quality materials and offering a high number of models with enhanced styling and features. We also thought it was really important to create a strong brand image and be perceived highly in the minds of our consumers. And we did this through our marketing efforts. We put a little more in the budget for our marketing and our celebrity appeal. We thought it was really important to win those bids. And lastly, we really wanted to establish customer loyalty through our free shipping, quick delivery, 1 to 2 weeks, and our rebate offers.
About our future performance targets. In year 20, we had targets of an earnings per share of $8, an ROE of 16%, a credit rating of A, and an image rating of 93. We easily met all of these performance targets, mostly because they're not too high, but they are, from what we could tell, like acceptable and sustainable performance. We learned early on that if we tried to stretch out too much and reach for higher earnings per share ROEs in 1 year, we could end up losing out in the next year. So we met that 1 year in year 20, and then in year 21 we push it a little bit farther and try and go for an earnings per share of 8.5 and an ROE of 17%, an A plus credit rating, and a 97 image, which we think we can continue because over the last couple of years we've been continuing to build all of these slowly and at the same rate every year.
Throughout the game, our company was able to capture and maintain a high percentage of the internet segment across all of the geographic regions. Our competitive strategy was to offer a high quality and high number of model strategy. Again, like I mentioned previously, really stressing the importance of high quality and customer loyalty. At first, we began with a penetration pricing strategy where we priced our product a little bit lower just to attract buyers and in all geographic regions and capture the market. And then after we solidified our brand positioning and increased our image rating, we were able to end with a premium pricing strategy because we offered higher quality, and we were able to do this in all of the geographic regions. So here are just some graphics of the North America and Europe, Africa segments, internet segments. And we pulled this from the BSG website, and this is something that we would look at every time we would make a decision or analyze our company's performance. And as you can see, in comparison to the other teams, we captured a very high percentage of the market by offering a high model strategy and high quality product. You can also see that the other companies were also very successful in capturing a large percentage of the market, but they used a very different strategy. And we felt that by offering high quality and high number of models strategy, that we were able to set ourselves apart and really create a competitive advantage. So these are our Asia Pacific and Latin America market snapshots. This is just a continuance of our previous slide. And as I mentioned earlier, we really offer high quality and a wide variety of products, and we kept this strategy consistent across all of our geographic regions. And this is what helped us sustain our competitive advantage throughout the game. So for the internet segment, we had multiple strengths that were able to set us apart as a company in the industry. Some of these were we offer the maximum amount of models that were offered in the internet segment, and this definitely gave us a competitive advantage over our other competitors because they didn't offer anywhere near the amount of models that we did. We also provided free shipping on all of our online orders, which helped us increase our image as well. And we started off offering 1 week delivery, which was the best in the industry, but we realized that we had to cut costs in some way, and we switched to 2 week delivery, which was what everyone else was offering in the industry, and we didn't think that that would hurt us very much. We also used a very high percentage of superior materials, and we were able to maintain a very high S&Q rating throughout the entire game. Looking at our main competitors in the internet segment, we decided that our main competitors were Company C and Company B. Throughout the game, at the beginning of the game, nobody even came close to us. We captured a really high percentage of the market. But as the game went on, these two companies were able to capture just as much, if not more, of the market than we were and performed really well. So for Company C, their strategy was a little bit different than ours. They offered a medium to high cost and medium to high models offered. And they kept this consistent in all geographic locations. And they were able to come very close to our percentage of the market in all of the geographic locations of the internet segment. They're also a 7 to 8 star company, which shows that they are also very concerned with quality, image, and celebrity appeal, just like we are. And we believe that they noticed that that was one of our strengths, so they imitated that and ended up doing really well. As I just mentioned, they come close to our company in online orders in all geographic locations, and they use a very similar advertising budget, which shows that they care about their marketing and their image as well. Company B offered a very different strategy than we did. They were a low cost and low models offered company, but they were also very successful. They competed with us on market share in all the geographic locations as well. They were actually an 8 to 9 star company despite their lower quality and low cost and low models offered strategy. And they came close to or outsold our company in online orders.
Now on to the next part, the competitive strategy wholesale market. This to me is the most exciting part because I like seeing who our competition is and see what we can do to improve ourselves. But our strategy when it came to the wholesale market was to focus on increasing our image rating, SQ rating, and other factors associated with these as well. We also pay very close attention to what our competitors were So our main competitor that we had was Company C. We saw that Company C was able to offer the same amount of models we were, which was about 200 models that we were able to offer. But also in relation to this, they were also able to offer them at a lower price than we were at the start. Company C also had the same strategy that we had when it came to doing stuff such as rebate, the clearance, such as also the delivery time and free shipping. And they were also able to use, they also use recycled boxes as well, I believe so. I believe. But companies.
So this slide is our competitive strategy for private label. And our strategy for private label was that we weren't going to get into it. There's a lot of reasons for this, and we'll break it down here. But the number one thing is that we were focusing on differentiation, and private label is kind of in the opposite of direction of that. They wanted a general product for a cheap price, and the whole point of differentiating was to offer a higher price and a better quality product. And the reason we wanted to differentiate was to avoid a price war. A private label, going for private label would just lead us into a price war with every other company. And we could easily lose our bid each week just because a company decided to go lower than us. We also didn't think it would benefit our image. Selling a low quality product for a low price, that's not something you see Nike do. And like we said earlier, that's something we compared ourselves to. We wanted to do things that Nike would do, and we didn't think that they would go into the private label either. We also didn't think it was necessary. Early on in the game, we were taking a lot of the wholesale market share and the internet market share, and so private label, we didn't need to put our production anywhere else. We were already producing and selling everything we were producing at the level we wanted to. And we thought it'd be more profitable to focus on wholesale and internet segments, which I think we showed to be true, because we didn't ever have to get into a real price war and could charge a premium for our product. So this slide is about how we plan to outperform our rivals. And throughout the game, we've been a very competitive company. We've always been kind of placed towards the top of the industry, and so we've seen several different types of rivals. As of lately, Company B has been one of our biggest rivals, and what they have been doing is getting a product out there that would sell, like the basic product that they could sell, and slapping a really low price on it, and then taking away a market share. And it does work, but as they continue to try and increase their image and grab even more market share, they're going to struggle to keep that low price, and then they'll end up kind of back in the same place. And since we have a lot of production capacity, if they want to produce a high quality shoe, we'll be able to outperform in the long run. And kind of the same thing with Company C is that they're trying to offer the same product as we are, the same quality. And one issue with that is that while we've been trying to reduce costs for several years now, they're just getting it. So we're kind of at an advantage to offer a lower price, even though we're offering a higher price than them. So I think in the long run, offering Company C won't be able to get away with offering a lower price product for too much longer. And so we're going to continue what we're doing and focus on sustainable growth, and that should keep us near the top of the industry for the years to come.
We learned many valuable lessons. The first lesson is to avoid price wars. As a company, we need to avoid these price wars, as they can have a negative long-term effect on both consumers and businesses alike. These price wars are bad for the consumers because they can drive companies out of business and give them a smaller selection of the products they want to buy. Price wars are bad for businesses because these prices companies can charge the customers go down, so does the profit margin with it. The next lesson we learned is that it's important to have a consistent strategy. If a business does not stay consistent with its processes, this allows for too many variables that can cause a fall in revenue. Staying with the system also made it easier to see where our profits are coming from. Prioritizing quality and image is also a lesson we learned. If our product is not made well and falls apart, this will spread quickly to our customer base. Modern customers can find out this information very quickly online. It is much more favorable to our company that they hear positive comments about our products rather than negative. Prioritizing our image also made it very easy to identify and what regions to produce and sell our product.